Stop writing. Stop writing. I will send it to the school app. Stop writing already. We're still on business ownership. Yesterday we talked about private limited company. Today we want to talk about public limited company. Yesterday was private limited company. For private limited company, these are companies that are run by friends and family. But for public limited company, they are incorporated business that can sell their shares to the public. Anybody could be part of the shareholders. That's why it's a public limited company. So yeah, it is an incorporated business which shares are being traded in the stock exchange market. Traded simply means you can buy and sell in the stock exchange market. The stock exchange market is that institution that allows the trade of shares. So you can as well go there to buy, and you can as well sell if you're a public limited company. So you become a public limited company because your shares are being traded in the stock exchange. Don't try what I'm talking. So that's a public limited company, an incorporated business that has its shares traded in the stock exchange market. What are the features? The formation. It has to be registered under what? The registrar of companies. The company name must end with PLC. So whatever company you see that the suffix is PLC means it's a public limited company. The company constitution must have article of association and memorandum of association. We talked about that before. Must have at least 7 shareholders and 2 directors, which simply means before you can become a public limited company, it must be owned by at least 7 people who are shareholders and they have directors, at least 2 directors. A prospectus. What is a prospectus? A prospectus is a document that states the objective of the business and why the business needs to sell its shares. So if you are going to sell your shares to the public wants to know why you want to sell shares. They want to know the kind of business you are doing. They want to know if the business is interesting or not. So every details about your business will be stated in the prospectus. So before you sell your shares, you need to prepare a prospectus. This prospectus will be given out by your bank. They won't come to your company to buy. They buy through the stock exchange or through your bank. So the banks will be the one in charge of selling your shares. But for them to sell your shares, you need to issue what? A prospectus. Do we understand what a prospectus is here? A prospectus is a document stating the affairs of the business and why it needs to sell its shares. You have to convince people to put money in your business. You do that with the prospectus. Do we get that? The next one is liability. Liability is the debt to the third party. The debt of the business does not affect the owners of the business. Liability. So whatever happens to the business stays with the business because the business is not the same as the owner. They have separate legal identity. So if the business is owing, the business has to pay back, not the owners.
Like the accounting.
Like the private limited company too. So whatever happens to the business does not affect the owners of the business. Limited. Finance. Can raise fund or finance through the sales of shares. If you have to sell your shares, you sell it through the prospectus. So if you are willing to sell your shares as a public limited company, you have to tender a prospectus and you have to tell the public why you are selling your shares before they could buy. But as soon as they buy, you have what we call issued shares. Issued shares. Before the issued shares, we have the authorized share. Authorized share. Authorized share is the maximum amount of shares you can sell. Issued share is the total amount of shares you sold. Get the difference between them. Authorized shares is the maximum of shares you can sell as a business. Issued share is the total amount of shares you sold as a business. Are they the same?
No.
This is the maximum you can issue. This is the maximum you can sell. But this is the total amount you sold. So as soon as you sell, you raise capital. We call it share capital. Share capital. That is the amount of money you make from the sales of shares. Do we understand that?
Yes.
Then control. The control is through the shareholders. The shareholders have the voting rights. That means they can elect during the annual general meeting, the AGM. They can elect the directors. They can elect those who are going to control the business. They do that through the annual general meeting. But each shareholder has one voting right. And when we talk about shareholders here, we're talking about Ordinary shareholders. Ordinary shareholders. Not preference. For preference shareholders, you are just shareholders like me or you. I could buy shares in Apple, but I'm not an ordinary shareholder of Apple. I'm just a preference shareholder. So we're talking about those who own the company. Do we understand? Do we get it or not? Separate legal entity. Yes, because the business, this is the business, and these are the owners. They are different. Separate legal entity. The owners are different from the business. Do you understand this? Taxation, they pay corporation tax like the private limited company. Unlike the sole trader and the partnership, they pay income tax. But any incorporated business, yes?
The tax that they give for
to the government.
Right? They give it for the income that they see or
the profits. The profits they make. That's why we call it corporation tax. Corporation tax is the tax on profits. Income tax is the tax on your income. Like I pay tax on my income, that's income tax. But why businesses like the sole trader and partnership pay income tax is because they are unincorporated business. They are being treated like individuals. That's why they pay income tax. But businesses that are incorporated, they pay corporation tax. Taxes on profits. Regulatory requirements. They must publish their financial statements to the public. Unlike sole trader and partnership. Dissolution. The shareholders start the business, they can also dissolve it or through the court order. And the last one, continuity of existence. Yes. Why is there continuity of existence? There's continuity of existence because it's an incorporated business, which simply means a shareholder could pass on, still the business will continue. That is continuity of existence. So if the shareholder, because it's a public limited company, I can as well sell my shares to someone I don't know. So if I'm selling my shares, it doesn't mean the business ends. The business continues. So whatever happens to the ownership of that business, the business continues to be in existence. That's why we say here, continuity of existence is what? Yes. Because whatever happens to the business is a going concern. The business is a going concern. The business will continue to be in existence forever. Is it clear? Any question about public limited company here? In the next class, we're going to talk about the advantages and disadvantages. Thank you.